What's up? Welcome to the Confluence.VC podcast. This podcast is meant to give you a personal glimpse into the next era of investors and operators. This week we had on Mack Kolarich with Assure. So for those that don't know, Assure is the OG most used SPV platform. SPV stands for Special Purpose Vehicle. They help anybody running SPVs by handling all their administrative work so that you can just focus more on getting deals done. Mack's the VP, and he also leads up their analytics team to leverage data to better understand trends. In this talk, we cover perspectives on building track record, SPV trends, and takeaways on innovation within the VC tech stack. All right, sweet. So Mack, appreciate you joining. Before jumping into some deeper questions, I think we like to just kick things off by learning a little bit more about you. So with that said, would love to just open this up with a quick intro on who you are and what your path was to get to where you are today.
All right. Well, thank you for having me. Excited to get to chat with you today. So my name is Mack Kolarich. I'm the vice president of both marketing and analytics at Assure. And we'll dive into Assure in a couple minutes here, but I really got my start into what I'm doing today through startup companies, fundamentally, being an entrepreneur. So years ago, actually right around the global financial crisis, I was coming out of school and was working on a small tech project with someone who ended up becoming my first co-founder, and a friend's boss, who also happened to be an entrepreneur, actually encouraged me to attend a startup weekend, funny enough. And I did. I had heard about these kind of 54-hour competitions where you could meet like-minded people fundamentally who are interested in trying to build things and turn them into businesses. And I attended really three different cities in quick succession, trying to kind of just see what different startup ecosystems were like. So I did LA, I did New York and DC, which is where I was living at the time. And that was kind of it. That launched me into my career to this date. Several years later, funny enough, actually through the Startup Weekend Network, I'd also ultimately meet my second co-founder on a subsequent company in Rio de Janeiro. But I started prior to Assure effectively really three different companies, if you kind of ignore pivots, and over time I've increasingly leaned into working in and around the financial industry in some capacity, really around private assets. So the first company was a SaaS marketplace to automate event PR. That was a fun one. The company was called Scene Squid, and really built these media networks in these cities across the US, and was doing SaaS in the early days of SaaS, when people were really just trying to figure out, how you measure these metrics differently, and what are you tracking, and sold to small and medium-sized businesses up to, in some cases, some large brick and mortar brands that were using us to activate their in-store events. My second company was really more of an angel organization. It was for profit, but in some ways it kind of looked and operated like Startup Weekend. Company was called Startup Angels, and we were fundamentally trying to increase the number of angel investors in startup ecosystems around the world. Got to work with thousands of existing and aspiring investors. We scaled our curriculum and held these kind of large angel summit conferences across the US, Europe, Latin America. And then the third company, which was acquired by Assure, was called Different Funds, which initially was a venture capital marketplace for LPs to try to help them find funds, but that grew into a research and data consultant for institutional LPs and family offices. And in that work, we built the largest data set on US venture firms and did tons of novel analysis and reports and publications that really kind of pushed forward what was known about the GP and LP dynamic. And so that work we were doing at Different Caught the eye of Assure. We'd known that team for a while because we respected their work they were doing with SPVs and kind of cost-efficient structuring of funds and support for private asset investors. And so they asked us to come on board and do what we've been doing it different, but really expand that work across all of Assure's data and start to think more broadly beyond just venture across all kinds of asset classes.
Nice. Well, that's a pretty good transition into a follow-up question we had, which was just diving into Assure a little bit deeper. I mean, we've obviously heard about you guys, we've done some work with you guys, but for anybody in our audience that has not heard of Assure, give us the quick elevator pitch on you all and specifically types of people that you guys target.
Sure. So we are basically back office experts, and we do more special purpose vehicles than anyone in the industry. So for those who don't know, SPVs are basically an efficient, simple, cost-effective way to raise capital from your network of investors in order to deploy into generally a specific deal that is already identified. Most SPVs are single asset, though some are double or multi-asset. And then as the organizer of an SPV, you can also do things like assess carry on that deal, take management fees, so on and so forth. At Assure, we have closed over 9,000 SPVs to date at this point and have been in business for over 10 years. And we offer end-to-end SPV support, including formation, compliance, administration, taxes. We have tax in-house, which is very rare in the world of kind of back office administrators, all the way through exits and distributions. And so given all these deals we've supported, it means that we've seen virtually every kind of deal that is done in the private markets and may make sense for an SPV, and virtually every kind of scenario that you might encounter in years 2, 4, 6, 8, or 10 of the life cycle of your SPV. So with us, we're not really surprised, and we can help see around corners, and we basically put things in place to avoid any challenges that may arise way down the road, even though right now you're thinking about, okay, let me get this capital raised and get it deployed into this deal that is pressing for me today. We work with all kinds of investors across quite a range of alternative assets. Clients range from VC firms to syndicate networks to angels. We work with broker dealers, merchant banks, family offices, real estate funds, crypto funds, you name it. If they might have the need for an SPV, odds are we've worked with at least some kind of investor of that kind of background or perspective. And then similarly for assets, a lot of the SPVs ultimately are going into startup companies from SAFEs to Series C, Series D rounds and later. But we also have SPVs that have invested across secondary transactions, private credit, real estate, rare art and wine and antique cars, lumber, film finance.
Got it. I didn't even realize that Assure covered that broad of a spectrum. I kind of just assumed that all SPV back office providers just focus more on startup investments because that's obviously the world that we play in. But I didn't realize you guys went that broad with it. I guess follow-up question to that is just from an outsider's perspective, it seems like SPV investments has become more and more popular as a form of financing, both for investors and startup founders. For the last, say 5 to 10 years, where do you think, and we're gonna follow up to this question later in talk, but where do you think SPV investing is headed? Like, do you think there's gonna be more and more of these SPV investments? Do you think, like from a founder's perspective, is there more value from taking SPV investment versus traditional fund investment? Just curious how you guys are thinking about the value prop of SPVs versus traditional fund investing.
Yeah, so it's a great question. I think first and foremost, certainly, we're seeing it grow. It's going to continue to grow. 2022 is compared to 2021, a bit of a down year to some extent in terms of overall activity, but that is basically in line with, every asset class, pretty much anywhere with a few exceptions. But if you look at it year on year and you take 2021 as an outlier, it's continuing to grow. 2022 is well above where things were at in 2020. And I think the reason that SPVs are growing in adoption varies by who's using it. Funds have different reasons to use it, from family offices, from founders, but there's a lot of merits to it across the board. From the founder perspective, I don't know that there's necessarily a strong, compelling reason to say, I want, to take capital from like an SPV per se versus a fund. The real value to the founder is the keeping a clean cap table, right? So if you've got a number of angels that are going to come into the deal, putting them into an SPV can simplify that process and make it cleaner, and sometimes a little bit easier to handle that back office administration. So there's merit there. In some cases, as a founder, if you're raising subsequent rounds and you've got a VC who's already committed, and they have pro rata rights, they may just choose to use an SPV in order to take those pro rata rights because they don't have sufficient capital within their fund to take it. From an entrepreneur standpoint, it's money in the bank, and it just makes it easier to report. Vice versa, for funds and for LPs, I think the big thing that's driving this adoption is flexibility and kind of transparency into where the capital is going. And we can talk about this more, but we're seeing a growing number of aspiring VCs choosing not to actually form blind pool funds, and instead they're building these syndicate networks that are really built around deal by deal choice for their investor networks. And I think we're still in the very early innings. We're seeing growth not only in the US, all across Europe. We're seeing other countries implementing kind of new regulatory frameworks to actually enable SPVs, since SPVs are not always easy or financially reasonable to do in different under different legal frameworks. Some are starting to think about how do we tokenize ownership. So it's early, and I think it's pretty exciting. We're just going to see more of this going forward.
Yeah, I mean that's kind of a good segue to next question we had, which was around the survey we ran with you all earlier this year. Just the survey, for anybody that didn't check it out, was really about how Confluence's members, which is primarily next generation VCs, think analysts, associate, principal level folks, how they're thinking about SPV investments. So what were some of the biggest takeaways that your team had from that survey? And I guess follow-up question to that, do you think everything, like the takeaways from that survey, do you think they still apply today? Or do you think there's anything that's kind of changed from then until now?
Yeah, so I, personally, but I know that, the market overall, in terms of people who are consuming content around private investing, people are interested in that next generation of investors and allocators that today aren't frequently benchmarked or always consulted. But I mean, your members are, they're the future of venture capital and of startup investing. I think it's really exciting to see what they're thinking. So some of the responses certainly mirrored what we expected to see, such as this was, in the spring of 2022. So things like rapid rates of capital deployment over the prior couple years, funds sacrificing on due diligence to get into deals. I think it's like something like 50% or so of respondents have said, yeah, we agree that we have done this. So those didn't surprise us at Assure. They just really confirmed things that we were thinking to be true from everything else we'd heard. But there were some aspects that did kind of surprise us. So one of the biggest standouts was for folks who took the survey and said that they didn't yet have a sufficient track record, or they're struggling to build one. 75% of those respondents said that that was due to not having enough capital to even get started. And I think part of the reasons why this surprised us is that if you can win an allocation in a deal and you've got a network of accredited investors, you can do an SPV and syndicate that deal and assess for some form of carry as a potential incentive, aligned incentive for accessing and diligencing that deal. That's possible. But kind of in conjunction with that was this lack of awareness of SPVs and how they're used by VC firms, by the junior level respondents. And we broke the survey into kind of senior, partner level investment decision makers, and then more junior level folks in venture or at VC firms, say like associates or folks like that, who fundamentally were really new to SPVs. Whereas the experienced investment decision makers, over 50% of them were already using SPVs as part of their strategy. So I think it was kind of this awareness disconnect that in our world we thought people were pretty aware, but it stood out to us that that they weren't. And when you're trying to or want to build a fund in the long run, getting that attributable track record is a challenge. And one way to do that is to go deal by deal, find great deals, and kind of test it out with your investor network and build that reputation. In terms of things that have changed or would change if we were to do another barometer kind of now, I think absolutely we would certainly see some pretty different responses. The world's quite different today from 6 to 8 months ago. So we've certainly gone from kind of a bullish to bearish perspective across the private markets and a lot of different asset classes. Although really what this is kind of the knock-on effect is, what that means is it's actually a lot better time to invest now. Valuations are compressing down, which means this vintage and likely the next vintage are where great deals are going to get done. So since we're not really overpaying for deals like we were last year at this point, that's great for anyone who still has the capacity and interest to deploy into startups or funds, because you're just getting better prices, better ownership amounts, and so on and so forth. I think the other thing we would see is fundraising cadences really starting to stretch out. We know a lot of funds have slowed the pace of capital deployment this year. We also know that LPs are getting a bit more careful and selective, particularly as it relates to emerging managers. We published a research article a couple months ago on our site under the analytics section that looks just at kind of capital flows in general across flagship funds, across SPVs, across opportunity funds, across fund stage, investment thesis, so on and so forth. And one of the things that we saw was that thus in the first half of 2022, first-time funds took just 6% of the capital that was raised by US venture funds. And if you compare that to 2020, in that year and at the same time period, first-time funds took around 20%. So that's down by over 2/3. And I think it's going to have some pretty significant consequences for the venture community in general in the medium run.
Yeah, it's interesting. It's a subject we've thought about a lot too. I think one thing that I wanted to get your take on as a follow-up to that is, as SPV investing has become more popular, I think there have become more LPs that these syndicate leads are competing for attention with. I guess the question I have is, have you noticed any strategies from syndicate leads of how they're breaking past that and getting consistently hitting the minimums that they have for targeted investment amount, when like today versus 5 years ago. Now it's just a lot harder to get those commitments because more people are asking those same LPs for those dollars. Is that a clear question? I feel like I just rambled pretty long on that. But like, I guess to compress that, it's like, how are you seeing syndicate leads go about the problem of like it becoming harder to compete for LP attention?
So it's a great question, and I can answer it to some extent. I'm not, tied in depth into, all of the fundraising and messaging materials that, any kind of organizer or, syndicate lead is sending out to their networks, but I do see some of it. So this, I mean, it's a host of strategies, and you do have to find what works for you. Telegraphing ahead of time is when you think you've got a deal coming up is good. The way you package your message matters. There certainly is competing attention for capital of really any investor, right? And do they go into bonds even, or publicly traded stocks versus a longer lockup in a private asset? And that's a question people are dealing with. I think one thing that successful syndicators can lean into beyond like, okay, why is this deal great? Why do I want this? If we're taking pro rata in a deal I'm already in, why am I doubling down? But is to lean in wherever possible into, favorable terms. That's one selling point, and I think savvy investors are still picking up on that and deploying capital. One thing we do track is just investor participation in not only venture funds, and that actually has ticked up quite a bit over the last few years. I think the median or average, I think the median flagship fund this year has 110 LPs in it. SPVs have a lot fewer investors. Sometimes you see high numbers, but usually it's much lower, closer to 10 to 35 and that kind of range. But the number of investors participating certainly has gone down this year, which is reflecting, some of your investors are capital constrained, or they have liquidity challenges, and they're just not, or their portfolio is way out of balance and they're hesitant to commit more to a particular asset class. That just does occur, but things are still happening. Last week, I was out in Napa at a family office conference talking about how family offices are using SPVs, and they use them similarly, but a little bit different from VCs. While the number of investors participating in a family office-led SPV has basically dropped almost in half from what we saw in 2021, what we're seeing is those who are still participating are actually starting to write bigger checks. So those that are sticking around are still believing in the organizer of the SPV, the deals that they're sharing, and they're putting more capital into it. So the median size, actually, at least in family offices, the median size of their SPVs has actually gone up over the last couple of years each year. Does that answer your question?
Yeah, it does. It does. I mean, I don't know if there's like a very clear answer to that question. I mean, I've tried to pick a lot of different people's brains on it, like how they're getting around competing for LP attention, like how LPs are thinking about it. But I think that gives like a better framework of thinking through things. I guess related question to that is, have you guys noticed any pushback from LPs as more and more SPVs are being launched? So the reason I asked is when I was thinking through this, I would think that if you are an LP and more like the person you're backing is just launching more and more SPVs, you're calling capital more frequently, which just creates more friction. Are you noticing any pushback from LPs because of this increased frequency, or am I just completely wrong? Am I thinking there?
So I think it's a great question to ask. Generally, not really. Now you could certainly kind of abuse or annoy your network and send deals that maybe aren't great, right? So you do have to think about, like, if I'm going to share a deal for whatever reason, does this pass my threshold, right? And because the environment is more investor friendly, I mean, you are, as the organizer or the syndicator, I mean, you're vetting that deal as well, so it should be more friendly to you as well, right? But people really like SPVs because of the flexibility. It's not a requirement to invest, right? It's not like an actual capital call like you'll see with a blind pool fund. And as a fund manager, there are merits to having those commitments and knowing that you have capital you can call. But then again, you're spot on. That is something you have to manage, and you have to make sure LPs are not surprised by too many capital calls. With an SPV, that's an up-down vote, and a lot of investors really do like the power of that choice. They also like that typically SPVs allow them to kind of buy down their cost of ownership. So if they've committed to your fund and then you're syndicating pro rata out on, a subsequent series B or C raise that, your fund is not equipped to take, but you believe in that company, a lot of LPs, particularly family offices, really like having that option because they can invest more capital, and it's at lower costs, candidly. I mean, a lot of SPVs do charge carry. I think for VC-led SPVs, and we have a huge report on this that we just published a couple weeks ago called How VCs Use SPVs. But as it relates to carry, I think there's 90% or so of any VC-led SPV has some kind of carry on it, and it's usually 20%. But then management fees are pretty rare. And when management fees are charged in the SPV, they're much lower than what is charged from kind of a fully blended average in a venture fund. And so this is basically cost savings to LPs that they don't have to commit capital to. They just have to spend a little bit of time thinking about, do they want to put into this additional capital in? They've likely, at least in pro rata, seen the deal already, and so they kind of know about the company, and they can make that decision. Now, some of it, this is where you have to kind of know and understand your investor network really well. You've got to kind of be in careful, not too frequent contact, but contact where you're monitoring how each investor really responds to, a deal or an SPV that you're sharing their way, and kind of monitor it, because some are going to want to see every single one. Some are going to want to see specific deals, and they may not be mad or, annoyed if you send them deals that are relevant, but some have specific interests, and some don't want to see it at all. And so the more you can kind of streamline your communications and pinpoint that targeting, I think that is great in terms of being careful how you use your investor bandwidth and when they pay attention to what you send their way. As it relates to like institutional LPs, which matters more for more established funds, a lot of times they don't want to be bothered with this kind of stuff. They want to commit to funds. They want to have that capital managed because they are manage a very complex, large portfolio, and you were just a moving piece in it. And so they're not interested in seeing those kinds of deals. That said, that's not true for all of them. So I know there are some pensions and endowments that actually are interested in taking on, kind of additional pro rata through SPVs, and have actually had conversations with some pretty large, even government or state government pensions that do this on occasion. So the more you can kind of just track that network and have your own CRM where you're measuring how people respond, I think the better position you are to not fatigue people.
Yeah, I couldn't agree more. I mean, I think it's an art more than a science of like figuring out the right cadence, not pissing off your LPs. I think the game that I've just noticed a lot of SPV leads play, which seems like such an uphill battle, is just to get a bunch of chase after a bunch of small checks and try to increase the size of their LP network without really seeing what the average check size is from those people, and just chase down a lot of smaller checks versus just partnering up with family office or some type of institutional investor that they prioritize getting them into deals and figure out what they like and then kind of match their thesis to that. So then you are essentially trying to please one larger check rather than chase down several.
It,
Kind of
yeah, it's a different strategy. I mean, you're right. Candidly, most first-time funds have to raise quite a few small checks,
yeah,
just in a blind pool fund. And so, folks who are starting syndicate networks, I mean, maybe doing the same. Some of this is like, who do you know? But it takes a while to build trust with family offices, let alone large institutional investors.
yeah,
So, you can kind of work your way into those larger checks over time. I think some of this depends on, how passionate are you about your thesis area and why you are an investor. I mean, you're right. It is a lot of work to wrangle lots of small checks. People certainly do it. Raising a first time fund or a second time fund is not any easier, right? And you kind of have to figure out what's going to resonate with your thesis and your brand, and the folks that you can get access to, who are going to give you the time of day on your deals.
yeah, totally agree. Well, let's see. Switching gears a little bit here. So last question I have before jumping into quick fire, but Assure was one of the really early players, I think, that addressed the venture capital tech stack. Over the last few years, a ton of new players have entered. I think it's like becoming one of the more innovative spaces within the tech world right now. How are you guys thinking about competition for VC attention, and what all are you guys doing to differentiate against some of the newer players that you're seeing now?
Sure. So great question. You're right. The back office landscape in terms of technology and just innovative approaches has changed significantly in the last 5 years, which is great because venture and private investing and more generally have not seen a lot of innovation over the last several decades, and so it is time that we're seeing more, and it's great to see attention and resources put towards improving really pretty frustrating experiences that a lot of people don't like dealing with. So it's a great business problem, but historically a lot of folks have ignored this in terms of innovation. As it relates to Assure, I first and foremost, I cannot understate just how far ahead of the curve Assure is on experience, and this can and does matter. So some of these new competitors are really just beginning to have to deal with complex tax situations, and they've hardly scratched the surface on things like membership transfers, let alone distributions. So those competitors are really using their clients as guinea pigs. We at Assure are way past that, and in most cases, we've seen your scenario and have a solution and a system already in place to actually handle it. So that's one just kind of major differentiator from us versus virtually all of our other competition, given the sheer number of deals that we've supported. But beyond this, we're thinking past just the SPV, just fund administration. And by the way, we do have CFO services for emerging managers. We really focus on kind of smaller funds, but we do that as well. And we're thinking about, okay, what else can we provide in terms of value and support and expertise to help investors make better decisions or be more aware of the market or more aware of where they fit in terms of their peers and competitors and their strategies. So this is, I think, where a lot of our analytics unit content and benchmarks comes in. We publish reports, analysis, commentary, thought leadership on, sure, yes, SPVs, yes, how SPVs are used by different kinds of clients and for different asset classes, but then we're digging into those asset classes as well. And particularly as it relates to venture and kind of our team's background, at the company Assure acquired different. We're really, we have a lot in the works in order to continue our prior analysis and research that we published while at Different, which is now with Assure. So in 2018, we published The State of Terms in Venture Capital, which nobody had ever done before. We had heard all this kind of inquiry from LPs and GPs of, well, what's market? What's market? I don't know what market is. I'm going to set this. This LP is saying that my terms are too high or look weird. And we were diligencing hundreds of funds through our marketplace and kind of institutional consulting work, and put together the first ever benchmark on this and rolled that out. And since then, it's been downloaded thousands and thousands of times and cited by lots of GPs and LPs. This is just like one example. Another one, and an area we intend to do a fair bit more work on going forward, is around like venture deck analysis. And people were, sending us we'd seen a lot of bad decks. People were sending us their decks for feedback. That still occurs currently. And we decided, hey, let's build a framework in order to try to structure concepts in that fundraising experience, where they're introduced in that deck, how managers of kind of different geographies or thesis areas or backgrounds, how do they tell their story to prospective LPs, and let's put it out there. So like in this deck analysis report, we found, okay, what's the median? It's 27 slides. It's 22 VC related concepts. They used 74 logos, which, by the way, is kind of crazy if you think about it. But that's just the surface. We dug into things like how our narrative is structured. What is the order of major concepts and where they're introduced? A couple like tidbits from that are, if we just take performance. So, and what kind of performance you talk about? Well, with first-time funds, most of them, they don't have performance, right? 52% of first-time funds, though, talk about non-firm related performance outside of that venture brand. Whereas second and later funds, more established funds, only 29% of them do. So like that's one variation. Whereas if you look at diverse-led funds versus non-diverse GP funds, they differ not only in their design choices, but diverse-led funds introduce performance way earlier in their decks. I think it's like 53% earlier. They're handling, in some cases, really, implicit and structural bias and trying to hit that head on of, yeah, here's my performance. Let's talk about it right now. Let's get it out of the way. Compare that to Silicon Valley-based funds, which are much more likely to talk about who they know. And lean into that kind of who are co-investors, who follow on. They tend to use logos even more than that 74 median. So pretty fascinating, pretty insightful. And this is informing how we think about what we're doing at Assure. So we're not just doing SPVs. We're looking at ways that we can add insightful value to our clients, to their investors, and to the market in general, in order to make private assets more accessible and help people make much more effective decisions in how they're allocating and how they're thinking about their full investment portfolio.
Yeah, it's really interesting. We'll absolutely link that entire report within this just so people can look at it for themselves. I feel like we could unpack that in a lot more detail, and I could probably ask 10 additional follow-up questions, but I think the easier route just to link it, let people dig in for themselves, and probably just like have a bunch of different findings from that.
Totally.
Sounds interesting.
And if people have, look, I found that the VC deck report, all of our research has been fascinating for different reasons, but the VC deck report I found, really interesting. People have questions or, would like to see certain kinds of analysis. We're all ears, right? Please reach out, open to suggestions. If we can do it, we'll try to conduct the analysis and put it out there.
Totally. Well, cool. You want to run through quickfire?
Sure. Sounds good.
Cool. So we got 5 questions here meant to be answered in 2 sentences or less. First one we've got is, what is a recommendation you hear regularly that you think is bad advice?
So I think my quick fire on this is a bit more nuanced. but it's that there's not necessarily bad advice that stands out to me. It's that the advice needs to work for your personality and your personal circumstances. People will give great or potentially great advice that they truly believe because it worked for them, but you've got to figure out whether you yourself can actually implement it and whether it sits right for you. So
I
that's
agree.
my, yeah.
Yeah, I agree. I totally agree. In the last year, what new belief, behavior, habit has most improved your life?
So for me, as part of the acquisition with Assure, I relocated to Denver, and kind of this new, I guess it's a habit, but in some ways a behavior, and it's becoming a belief, is driving or commuting in order to run. I don't have to do that. There's some great running routes near me, but there's some absolutely amazing running just a short drive away from where I live in every direction. I never wanted to do that. When I was younger, of no interest, I was like, let me just run when I exit my apartment. But now I'm seeing the merits of no, sometimes it's worth that extra drive.
Yeah, just for better views.
Yeah, yes.
Yeah,
Yeah.
figured. Yeah, I mean, I feel like after literally a month of living in somewhere, you just get tired of seeing the same scenery every single day. Like you got to switch it up.
Well, and not to plug Denver because I know we're growing very quickly, but it literally is in every direction. There's some kind of an incredible spot, whether you want to go to Rocky Mountain Arsenal or you go south and it's a totally different environment, or you head into the mountains, or you pop over to Golden and you run up canyons as the creek runs by. It's pretty cool.
Yeah, I've only flown through Denver. I've never actually been there to visit, but I need to. It's on my short list. Place in the States I need to go. Let's see. Next one we've got is, what is one piece of advice you'd give to somebody starting a company today?
So I know we talked about advice, so take this with a grain of salt, but um, someone once told me this, and I don't remember who it was, but I appreciate their words of wisdom. It's that if you're not nervous at least 50% of the time, you're not trying hard enough. Now, that nervousness ebbs and flows, and sometimes it's great to be in kind of a flow state without that nerves and just super high productivity. But I think that's like a good barometer, particularly as a founder, but anyone who's trying to really build something. I think that's a good barometer to make sure you are growing.
Yeah, I agree. I've heard that from a couple of people now, and totally agree. I mean, I think if you actually want something, like at least something about it should scare you, or at least like the process to get there scare you. It shouldn't be all smooth sailing. So I think
Yeah.
it's good.
Well, it just unlocks it unlocks that next level. Like I one of my activities I enjoy or hobbies that I don't oftentimes have the time to do, but I really enjoy mountaineering, right? Like on ice, glaciers, that kind of stuff.
Mhm.
And candidly, each time I've gone out on any kind of serious trip, I am pushing myself and it's kind of scaring the hell out of me.
Yeah,
But when I come back and I think back about it, it like puts not only, that experience and, the next time I go out is better, but also it puts a lot of other problems into, better context of like, okay, I did this, I challenged myself, I can certainly handle this other thing.
yeah. I mean, stuff like that makes typing on a computer seem pretty chill. Like there's not, it's not a whole lot of pressure.
Absolutely.
What's something you believe that most other people don't?
So this is kind of a tough one. I think there's lots of things that I suspect I see a bit differently, but I've not really dug into depth on what are the kind of what is the median opinion on a lot of that. But I think one that maybe comes to mind first, just because we are talking about rising interest rates and central bank policies, and that's in the news a lot. is that the quote unquote risk-free rate isn't really risk-free. And there is a risk there. You can kind of debate endlessly to what extent the risk is present, but it's not actually risk-free. It's just the least amount of risk in a lot of kind of accessible assets today.
Yeah. I haven't heard that before, but I think it's true, like now more than ever. Last one we've got. If you had one ask for our listeners, what would that ask be?
So obviously it would be to check out Assure and all our amazing research that we're producing for VCs around SPVs and funds more broadly. But beyond Assure, at my core, I love working with emerging managers and angel investors and people who are trying to back the next generation of innovation. And so I want all of us to be successful. And so I would say for your listeners, think carefully about your investment thesis and really figure out why it makes sense for you. Like drill into that, nail that story, know that like the way you're investing is right. And if you have that, I find that goes a long ways with resonating with prospective investors in your funds or SPVs or however you decide to raise capital.
Yeah, I think it's good advice. Couldn't agree more. And that is all the questions I got for you, Mac. It's been awesome. It's been really insightful. I think I got a lot out of this. I think our listeners will too. But yeah, I just want to say thanks again for coming on.
Right on. Thank you for having me. Excited to hear more about what you guys do as you grow your organization as well.
Huge thanks to Mac for coming on. We hope that each of you are able to pick up something valuable from this talk. If you're looking to get in touch with Mac, we've linked his social info in the description below, and you can also get it a hold of Assure by going to their website at assure.co. For next steps, if each of you have not submitted your info to become a member yet, you can do that through our website at www.Confluence.VC. And also, if you want to become a subscriber to the newsletter, we offer a ton of free resources in there each and every week meant to help you become better at your individual roles. You can subscribe there at www.confluence.substack.com. Hope that helps. Hope to hear from y'all soon.